What if there was a single, repeatable trading pattern out there that could, according to one source, be a path to making $100 a day? Well, that's the big claim we're going to dig into in this explainer. So let's break down this strategy and see exactly how it's all supposed to work. So yeah, this is the magic number at the heart of the whole thing. $100. The source claims this isn't some pie-in-the-sky goal, but a target you can actually hit day in and day out, if you follow a very specific structured plan. The question is, what's the plan?
Here's our game plan. We're going to start with the pattern itself, what it looks like. Then we'll get into the anatomy of it. After that, we'll cover 2 super costly mistakes you've got to avoid, 3 advanced strategies to level up, and finally, we'll wrap it all up with the actual $100 a day blueprint.
All right, let's dive right in. The entire strategy we're looking at is built around spotting one single specific formation on a chart, which the source simply calls the 3-bar pattern.
So what is this thing really? Well, at its core, it's just a very specific sequence of 3 price bars. You might know them as candlesticks. The whole idea is that when you see this exact formation pop up, it's supposed to be a flashing light, a signal that a powerful new trend might be kicking off, and that could be your moment to get in.
Okay, so it's one thing to know the name, but being able to spot this thing in the wild, on a live chart, that's the real skill. So let's get into the nitty-gritty and break down the anatomy of this pattern, piece by piece. It really all boils down to these 3 bars happening in order. First up, you've got the igniting bar. This is a big, beefy candle that screams strong momentum. Then you get the pullback bar, which is a smaller candle going the opposite direction. Now, the source is super specific here. This bar can't be more than half the size of that first one. And finally, you get the confirmation bar, which pushes back in the original direction and closes past the pullback, basically confirming, yep, the trend is back on.
And what's cool is, this pattern works both ways. For a bullish setup, where you think the price is going up, you're looking for that green-red-green sequence. But for a bearish setup, you just flip it on its head. A big red igniting bar, a little green pullback, and then another red bar confirming that the price might be headed down. Same idea, just inverted.
But hang on, just spotting the pattern isn't enough to start printing money. The source makes it really clear that there are a few common traps that can completely invalidate the signal. So let's talk about 2 of the most costly mistakes it says you absolutely have to avoid.
Okay, the first major blunder that the source points out is all about that very first candle. They call it forcing the igniting bar, and really it just means you're seeing what you want to see instead of what the chart is actually showing you. And here's the difference, plain and simple. A valid igniting bar, like you see on the right, has to be big. We're talking noticeably bigger than the candles that came before it. The source says that's your sign that real money, real momentum is behind the move. If it's just some average-sized candle, that's a fake out. It's an invalid signal, and the advice is to just stay away. The second big mistake is all about context. See, it's not enough to see the right pattern, you have to see it in the right place. And the error here is trying to trade this pattern right after the price is already shot straight up or straight down. This slide shows it perfectly. On the left, you've got that crazy, almost vertical move. The source warns that moves like this are usually exhausted and about to reverse. What you want to see is the setup on the right, finding the pattern inside a nice, steady, gradual trend. In that context, the pattern confirms the trend is continuing. It's not signaling the grand finale. Okay, so now we know the pattern and we know what not to do. So how do we make the signal even stronger? Well, the source lays out 3 advanced strategies that are designed to help you filter for only the highest quality setups. First up, trend confirmation. This one is simple but powerful. Don't fight the overall trend. To figure out the trend, the source suggests a 50-period exponential moving average, or EMA. Just think of that line as the average price. The rule is dead simple. If the price is trading above that line, the trend is up, so you only look for buy signals. If it's below the line, the trend is down, and you only look for sell signals. Easy! The second strategy is about using key historical price zones. You're basically looking for support levels. Think of them as price floors, where the price has bounced up from before, and resistance levels, which are like price ceilings. The idea here is to find our 3-bar pattern forming right at one of these important levels. A bullish pattern at a support level, a bearish one at resistance. It's like getting a second opinion from the market that this is a good trade. And the third advanced strategy is all about breakouts. When the price has been stuck moving sideways, kind of coiled up like a spring, and then it finally breaks free.
Those breakouts can be explosive. So according to the source, if you see our 3-bar pattern forming right as the price is breaking out, that can be an incredibly powerful signal to jump on and ride that new wave of momentum.
So we've got the pattern, the mistakes to dodge, and the advanced filters to sharpen our aim. Now let's put it all together. Let's get to the part you've probably been waiting for, the actual numbers behind that big claim, the $100 a day blueprint. But first, a super important reality check from the source. This plan to make $100 a day is not about winning every single trade. Not even close. The plan fully expects you to have losing trades and even losing days. The real goal here is to be profitable over the long run, where your wins are just bigger than your losses. So, what kind of money do you need to start with? Well, the source bases all its math on a $5,000 trading account. But they also point out that you can absolutely start smaller. You just scale down your profit target to match. The principles are exactly the same. And this slide right here lays out the exact math. On a $5,000 account, every trade uses a $500 position. But check out the risk rules. This is the secret sauce. The profit target is a 20% gain, which is $100. The stop loss is a 10% loss, or $50. That gives you a strict 2-to-1 reward to risk ratio on every single trade. Now you might be asking, how do you get a 20% gain from a small price move? Well, the answer is leverage, and you have to be careful here. By using 5x leverage, a little 4% price move in your favor gets magnified 5 times, hitting your 20% profit target. But, and this is so important, it's a double-edged sword. A tiny 2% move against you also gets magnified 5 times, hitting your 10% stop loss and kicking you out of the trade. So let's see how this plays out on a day where you're right just half the time. Let's say you take 4 trades. Your first trade is a win, you're up $100. Nice. Your second is a loss, so you give back 50. Trade 3 is another winner, plus 100, and you finish the day with one more $50 loss. So, after all that, where do you stand? Well, you had 2 wins for $200 and 2 losses for $100. Your net profit for the day is exactly $100. That's the power of that 2-to-1 risk-to-reward ratio. You can be wrong half the time and still hit your daily goal. So the source lays out a very clear, very mathematical plan. The rules are defined, the numbers add up. But it all leads to the big question, doesn't it? A plan is one thing, but is the real secret key to all of this just having the discipline to stick to the plan, day in and day out? Is managing your own psychology actually the hardest part of the entire strategy?